What happens if you're sued by a patient but you're certain the lawsuit is meritless? Your insurance company might want to settle the case to avoid risk and expense, but you might prefer to fight because you're confident that you did nothing wrong. Can you refuse the settlement and take your chances in court? Well, the answer hinges on one detail in your malpractice insurance policy, and that's the consent to settle clause. In today's video, we'll clarify exactly what this clause means, how it affects your options during a lawsuit, and why understanding it is critical to protecting your practice and reputation. So if you're interested in learning more, please stay tuned. Welcome to Insurance by Dentist, where we are dedicated to educating and simplifying insurance for dental professionals. My name is Orrin Pearson. I'm the Vice President at Insurance by Dentist and the author of the book Insurance for Dentists, Malpractice Edition. Thank you so much for joining me today. We bring you brand new videos every single week, so if you enjoy this video, make sure to like and subscribe for more content. Let's jump right into today's topic, the consent to settle clause. A consent to settle clause is the part of your malpractice policy that states who must approve any offer to resolve a claim. Essentially, it spells out whether you or the insurer has the final say on settling versus going to trial. What that promise actually looks like depends entirely on how the insurer writes the clause and on which variant of the consent to settle, or its tougher cousin, the hammer clause, your policy contains. But we'll break down those different versions in detail later in the video. But for now, just remember that the wording in your own contract dictates how much control you really hold when a patient sues. Now, why would an insurance company prefer to settle? Well, insurance companies often prefer settlements over going to trial for several reasons. The first is cost control. Trials are typically expensive, involving attorney fees, expert witness costs, court fees, and other associated expenses. And a settlement often provides a predictable, lower cost alternative. Next is risk management. Trials are unpredictable, even when the case seems clearly meritless. There's always a chance that a jury could rule against you, potentially awarding damages far higher than a negotiated settlement. And the last, time efficiency. Lawsuits can take months or even years to resolve through the courts. A settlement resolves the issue faster, allowing the insurance company to close claims quickly and manage their caseload effectively. In short, settling gives the insurer greater control over the financial outcome and helps them avoid the risk and uncertainties inherent in courtroom litigation, even when you're confident you did nothing wrong. Why would dentists prefer not to settle? Well, dentists often prefer not to settle a malpractice claim for important professional and personal reasons. The first reason is reputation protection. Accepting a settlement, even if meritless, can be perceived as an admission of guilt or wrongdoing. Dentists might choose to defend themselves in court to protect their professional reputation and maintain patient trust. The next is National Practitioner Databank reporting. Any settlement payment made on behalf of a dentist is reported to the National Practitioner Databank, a federal database. Having entries here can significantly impact a dentist's professional reputation and future opportunities. The next is increased premiums. Settlements, even considered minor, can lead to higher malpractice insurance premiums, causing ongoing financial consequences for the dentist. The last is state licensing concerns. A malpractice settlement could trigger investigations or disciplinary actions from licensing state boards, potentially jeopardizing the dentist's license to practice. Now, the bottom line is a settlement can follow you around. That's why many dentists choose to fight. They want to keep their good name, avoid a lasting black mark on their record, and show they won't roll over for a weak claim. Now, let's consider what happens if your policy does include a consent to settle clause, but then your insurance company strongly believes settlement is the best option, and you disagree. Well, in that situation, a provision known as a hammer clause may come into play. The hammer clause, also called a modified consent to settle clause, permits you to refuse a proposed settlement, but then holds you responsible for any additional costs that exceed the amount the insurance company was willing to pay to settle the case. By doing so, the insurer protects itself from liability beyond what it deems a reasonable settlement. In practice, this means you retain the power to decide whether to settle or proceed to trial, but you assume the financial risk if the final verdict or total expenses end up higher than the original settlement offer. If you're confident in your defense and the likelihood of a favorable outcome, the hammer clause may not deter you from fighting a meritless lawsuit. However, if the risk of a larger judgment or simply prolonged litigation loom large, you might think twice before rejecting the insurer's recommendation to settle. Understanding whether your policy includes a hammer clause, as well as precisely how it is worded, is crucial for planning your legal strategy, managing potential cost, and maintaining full awareness of your financial exposure when you decide to fight rather than settle. So now that you understand the basics of the consent to settle and the role of the hammer clause, let's discuss the specific types you might encounter and how each one could influence your decision to settle or go to court. The first type I want to look at is pure consent clause. A pure consent clause ensures that your insurance company must secure your written approval before settling any claim. If you turn down the proposed settlement and opt for a trial, the insurer remains responsible for the entire judgment, up to your policy limits, and all your legal defense expenses. Even if a jury awards a $2 million verdict against you, your insurer is still on the hook for that amount, assuming it's within your policy's coverage limits. Simply put, there are no hidden penalties for choosing to defend your reputation in court. The next type is a standard hammer clause. Under a standard hammer clause, like we talked about before, you retain the right to approve or reject a settlement. However, if you decline a reasonable settlement offer that your insurer wants to accept, the company can limit the amount it will pay if the case goes to trial and you receive an unfavorable judgment. For example, suppose your insurer deems $300,000 to be a fair settlement. You then refuse, insisting on fighting the case in court. If you end up losing and the court awards $700,000 in damages, the insurer may only be obligated to pay the $300,000 it originally offered, leaving you personally responsible for the remaining $400,000 plus any additional legal expenses you accrued after your refusal. The third type I want to look at is the pounding hammer clause. A pounding hammer clause goes a step further than the standard version. If you refuse to settle when your insurer believes it's the best course of action, the insurance company will pay out the amount of the proposed settlement and any legal fees accrued up to that point, and then effectively withdraw from the case entirely. This means you would be on your own to cover all future legal defense costs and any judgment that exceeds the amount the insurer has already contributed. So if your insurer wanted to settle for $200,000 plus $50,000 in fees but you decline, they could hand you that $250,000 and effectively say, good luck. If a jury later awards $1 million, you'd be responsible for everything above the $250,000 you already received. The final type is modified hammer clause. This is often referred to as a co-insurance arrangement. The modified hammer clause means that if you decide to reject an insurer-approved settlement offer, you only take on a percentage of any judgment above that amount. Common split percentages might be 50-50 or 70-30. This scenario shares some risk between you and the insurer, but still requires you to bear a portion of this potential financial fallout. For instance, imagine your insurer is prepared to settle a claim for $500,000, but then you decide to go to trial and you lose. This results in a $900,000 verdict. With a 50% modified hammer clause, you would be responsible for half of the $400,000 overage, $200,000, while your insurer covers the other half, provided the total payout stays within policy limits. Now that wraps up the different consent to settle and hammer clause variations. Remember, state law can trump whatever your policy says. In some jurisdictions, the insurer can settle on your behalf once a statutory trigger is met. For example, in Indiana, a unanimous 3-0 medical review panel finding against a healthcare provider lets the carrier settle without the provider's consent. So know your state's rules so you can negotiate policy terms and map out your defense strategy accordingly. Understanding these various consent and hammer clauses and how they can shift the financial and legal burden is critical to choosing the coverage that fits your priorities and risk tolerance. So, if you're in doubt, be sure to consult an attorney or your insurance professional to ensure you're fully aware of the implications of each clause in your policy. Choosing whether to settle or go to trial in a malpractice lawsuit can have lasting impacts on your career and your reputation. Knowing exactly how your insurance policies consent to settle clause and potential hammer clauses operate is essential to making informed decisions when claims arise. By understanding which type of clause you have, pure consent, standard hammer, pounding hammer, or modified hammer clause, you can better anticipate the financial and professional risk involved. Now that's going to end today's video. Thank you so much for watching. If you found this video helpful, hit that like button and subscribe to our channel for more content. We bring brand new videos every week on insurance, risk management, and practice building tips. And if you have any questions or suggestions for future videos, leave a comment down below. I'd love to hear from you. And remember, if you want to explore these topics in greater detail, you can find my book, Insurance for Dentists, Malpractice Edition, in the description below. And if you need personalized guidance or have any more questions, feel free to reach out. We're here to help. I'm Warren Pearson, Vice President at Insurance by Dentists. Thank you so much for joining me, and I'll see you in the next video.